Welcome to Eastern River's International Fixed Income Market Update for the week of March 24th to March 28th, 2025. Let's explore the key movements that shaped global bond markets this week. In the United States, Treasury yields moved lower as the Federal Reserve kept rates unchanged. Fed officials highlighted ongoing inflation risks, especially from new tariffs. The 10-year Treasury yield dropped 7 basis points, closing at 4.25%. Meanwhile, investment-grade corporate bonds gained 0.63%, driven by strong demand and tightening spreads. Over $4 billion flowed into the sector, signaling growing investor confidence. In Europe, markets reacted sharply to a US announcement of 25% tariffs on car imports. Automaker stocks declined, and the European Central Bank hinted at more easing ahead. ECB board member Piero Cipollone cited weakening inflation and energy prices, with markets now pricing a 60% chance of a rate cut in April. In Asia, China ramped up government bond issuance to a record 3.28 trillion yuan in Q1, as the government pushed stimulus to support growth. Total bond issuance for the year is now projected to exceed 11 trillion yuan. This comes as tensions with the US continue to weigh on sentiment. Emerging markets remained under pressure from global trade and geopolitical risks. While many regions saw cautious outflows, some opportunistic investors moved into higher-yielding assets, resulting in selective inflows and temporary stability in local bond prices. Back in the US, corporate bond markets remained resilient. Investment-grade spreads narrowed, while high-yield bonds were mixed amid macro uncertainty. Municipal bonds held steady, despite a large supply of new issues and minor outflows. This week's fixed income landscape was shaped by central bank policies, global trade shifts, and fiscal strategies. As always, Eastern River is here to help you stay ahead of the curve. Thanks for joining us, and we'll see you next week with more market insights.